Hi everybody, and welcome back to my channel. Today we are going to be talking about Repay Loans, which is a student loan repayment plan offered by the government that you might be considering if you're trying to lower your monthly student loan payment. I'm Melissa Ford. Welcome to Damsel of Success, where we talk about all things money. Please be sure to like and subscribe and hit the bell to be notified when I post a new video. So let's talk about the Repay Loan. First of all, what I'd like you to know about the Repay Loan is that this isn't a temporary program. It's not like a deferment or a forbearance, which you might pursue if you're having trouble paying your bills for a little while, for a short period of time. This is more of a long-term program. This is also not a part of the loan rehabilitation program, which is something that you might be going through temporarily to reinstate your loans if they got into a state of default. That's not what this is. So let's talk about what the Repay Loan is. First of all, like I said, it's a long-term program. So instead of having your student loans be paid in 10 to 12 years like a standard student loan would be, this loan repayment program has it broken out into 20 years, which makes your monthly payment potentially smaller. The next thing to know about a repay loan is that your payment is based on a percentage of your income. This is an income-driven repayment plan. And if you haven't already, I'd highly suggest that you watch my video on all income-driven repayment plans, which I will post up here. In the case of the repay loan, the amount of your payment is based on 10% of your discretionary income. And we will get into how to calculate that a little bit later in this video. But the thing that you need to pay attention to is that 10% amount. It's a very small amount. It is the smallest of all of the income-driven repayment plans. REPAYE stands for Revised Pay-As-You-Earn. So this is an updated version of another program that still exists called the PAY program, which I have already posted a video about, and you're welcome to watch that right here. So what makes a repay loan so special? Well, those two things that I mentioned just a moment ago, the fact that it's based on 10% of your discretionary income and the fact that it's a 20-year loan length as opposed to a 25-year in some cases for other income-driven repayment plans, those two things make it really special. Like all IDRs, this particular repayment plan is meant to lower the balance of your monthly payment. But the other really special thing about all IDRs is that once you reach the end of the loan terms, in this case 20 years, like I said, then any balance that you have left on that loan is completely forgiven. That means that if you have $10,000 left on that loan at the end of that 20 years, you are not responsible to pay that back. The loan is considered paid in full by the government, which is pretty great. Now that does come with a little bit of a caveat in that when you have that amount that's been forgiven by the government, it is added to your taxable income for that year. So as just an example, if we have again that $10,000 amount that's been forgiven and you were in a 25% tax bracket, that year you would be responsible to pay out of pocket $2,500 or 25% of that $10,000 balance. Now there's one other benefit with the repay loan that's different from all of the other income-driven repayment plans or IDRs. In the repay loan, there is a 50% interest subsidy. So what does that mean? It sounds kind of confusing, right? So what that means is that as you're paying, there's a good chance that the amount of your payment may not cover all of the interest that's accruing that month. So for example, let's say that you pay $250 a month on your student loans under the repay plan. And let's also say that your loan balance is large enough that your actual payment in interest in order to pay off all of the interest that month that had accrued that month would be $500. So $500 minus $250 is $250. And that is an amount that ultimately you'd be responsible for paying off. But with the repay loan, they offer a 50% interest subsidy, which means that the government will pay 50% of that accrued interest amount that isn't being covered by your payment right away. They'll pay that right away and you won't be responsible for paying that amount off. So in the example I just mentioned, where there's a $250 balance that you would be responsible for paying, the government would pay $125 of that and you'd only be responsible for the other half. So what are some reasons that you might not want to pursue a repay loan? Well, like all IDRs, it extends the life of your loan. So rather than paying off your loan in 10 to 12 years, you'll be paying on that loan for 20 years in the case of a repay loan. And during that time, interest accrues, and you will be responsible for paying that off in one way or another. Another downside is that the average borrower is most likely going to pay this loan off before any amount is forgiven. So while that forgiveness amount is really nice to have as a backup if something should happen, well, chances are pretty good that as your income rises, you're going to be able to pay this loan off prior to it even getting to the point where there's a balance to forgive in the first place. And like I said before, if there is a forgiven amount, that would be added to your taxable income for that year. And so you'd probably need to look ahead and start saving up to pay off that tax bill. Now, another thing that's a little bit different about these repay loans is that they're not capped, which means that as your income rises and your payment rises, there's no top point at which the payment stops rising. So it will gradually increase with your income, even to the point where you'd be paying more than you would have paid under that standard loan repayment plan. So, for instance, let's go back to our example. Let's say that your standard loan repayment plan would have been $500 a month. And under the repay program, your first initial payment is calculated as $250 a month. Well, under most IDRs, the most that you would ever pay on that loan is $500 a month. But under this program, you could actually increase above that $500 a month amount. And that happens if your income rises. So it's still based on a low percentage of your income, and it's always calculated in a way that's meant to be affordable to you. But that amount can rise above that $500 amount that you would have been paying under your standard student loan repayment plan. And there is no cap to that. So just keep that in mind. There are two more smaller downsides that you should just be aware of if you decide to pursue a repay loan strategy. The first is that, like all IDR plans, this is a program that you have to reapply for, or recertify, I should say, every single year. So it's something you're going to need to monitor throughout the life of the loan. Second, and this will only apply to some of you, if you have a spouse, your spouse's income will be considered to calculate your discretionary income. So if you have a spouse that makes significantly more than you do, this might not be the repayment strategy that you should pursue. So you've weighed the pros and the cons and decided that this might be a good loan for you. Well, now we need to look at whether or not you're even going to be eligible for this loan. Luckily, this loan is not one with super high eligibility standards. In fact, the eligibility standards are kind of low. First of all, like all IDRs, it has to be a federally backed loan. It can't be a privately backed loan. Second is that you cannot be in default on your student loans. If you are in default, you should consider something called the Loan Rehabilitation Program, which will get you to a point where you would be eligible to pursue some of these IDR options. The biggest thing that you have to really look at in terms of being eligible for a repay loan is the type of loan that you have. I'm going to put up a chart here that shows you the kinds of loans that are eligible for a repay loan program. So loans that are considered eligible right from the get-go are direct subsidized loans, direct unsubsidized loans, direct plus loans made to graduate or professional students, and direct consolidation loans that did not repay any plus loans made to parents. Loans that are eligible, but only if they're consolidated, include subsidized federal Stafford loans from the FFEL program, unsubsidized federal Stafford loans, also from the FFEL program, FFEL plus loans made to graduate or professional students, FFEL consolidation loans that did not repay any plus loans made to parents, and federal Perkins loans. Loans that are not eligible include direct plus loans made to parents, direct consolidation loans that repaid plus loans made to parents, FFEL plus loans made to parents, and FFEL consolidation loans that repaid plus loans that were made to parents. So as you can see, there are a lot of loan types that are accepted to be a part of the repay program. The only real exception is loans that were made to parents. And if you're looking to lower your monthly payments on those, really the only option in terms of an IDR program is called an ICR. And I'm going to post a video about that in the future, so stay tuned. One other eligibility consideration is actually a really good one, and that's what you don't have to show. Some of these IDR programs require you to qualify as a new borrower or to demonstrate partial financial hardship. And in the case of the repay loan, that is not a requirement. So I'm not going to get into what that means in this video, what those terms mean, but if you have a curiosity about what that means, you can check out my video on all IDRs, which I'll post up here one more time. So probably the biggest question on your mind right now is how much you're actually going to pay every month. And lucky for us, there is a formula for that. I'm going to put some graphics on the screen right now so you can kind of follow along with how we calculate this. The payment formula is calculated as your AGI minus the federal poverty line times 150%. Then you multiply that balance by 10% and divide that number by 12 to get your monthly payment. So like you can see, in order to calculate these numbers, we need your AGI, the federal poverty line number, and the payment percentage of your plan, which in this case is 10%. Now, if you're looking for your AGI, all you have to do is look at your 1040 tax filing form. It will be on page 1, line 11. That's your adjusted gross income. So now we're going to take a look at what the federal poverty line is. And I'm going to warn you in advance that these numbers are super low. And I have said this in my previous videos about IDRs, but it's kind of shocking to me how low these numbers are. What the actual line is that we consider people to be in poverty. So just be forewarned. Here is what the federal poverty line is. So as you can see in this chart, the federal poverty line is considered for a single individual as $12,760. Now that is the case in every single state except for Alaska and Hawaii. So if you live in Alaska or Hawaii, you're going to need to reference your own state's guidelines for what the poverty line would be. This chart breaks down your poverty line based on your household size. So it goes from 1 to 8, and if you have a household with more than 8 people, then you would just add $4,480 for each additional person. So let's get into an example of how this works out, because I know I'm throwing a lot of math at you and that can get super confusing, but I promise it's a lot simpler than it seems. For the purposes of this example, we're going to make a few assumptions. The first is that you're single and that your family size is 1. So you don't have any children or dependents. Next, we're going to assume that you live in the lower 48 states and not Alaska or Hawaii.
We'll say that you have a $45,000 student loan, which you'll repay over a period of 10 years at a 6% interest rate.
We're also going to assume that your current salary is $40,000 a year. We're also going to assume that over time, you're going to average out at about a 5% increase in your salary every year, which is actually based on an analysis that was done by the Federal Department of Education and the Federal Department of Treasury, that on average, college graduates can expect about a 5% increase in their salary every single year. So that's what we're going to use in terms of this example. So let's get into our example of how you can calculate what your monthly payment would look like under those terms and using the formula that I provided earlier. So first we're going to take that federal poverty line number and we're going to multiply it by 150%, because that's what the calculation is for the repay loan, which is not necessarily the same calculation for every loan, by the way. But we're going to take that FPL number, multiply it by 150%, and we will get a result of $19,140. If we take your AGI as $40,000 and subtract that $19,140, the resulting balance is $20,860. And that is considered your discretionary income. So we know what our discretionary income is. Now we need to take that discretionary income amount and figure out how much our monthly payment would be. So we landed on that number of $20,860. The first thing that we're going to do is multiply that by 10%, because the repay loan says that the maximum you'll be responsible to pay is 10% of your discretionary income. And that gives us a total balance of $2,086. But that balance is for the whole year. So in order to get our monthly payment, we'll just take that $2,086 and divide it by 12. And that number will be $173.83. So under these circumstances, if you were to have a standard loan, you would be paying $500 a month under those exact same conditions. But under the repay program, your initial payment, and like I said, it rises as your income rises, but your initial payment would only be $173.83 every month, which is a really significant difference every month and a very meaningful one if you're early in your career or if you're pursuing a career that, just has a lower income. Another thing that I really want you to be aware of as you're choosing which IDR loan to go with, and as you're considering the IDR loan, is what that payment might look like over time. So using those exact same parameters, let's just take a quick look at what your payments would look like over time. So for the repay loan, like we said, your first payment would be $173.83. Your last payment, however, would be $592. So remember how I said that this payment isn't capped? Well, you can see that in this example, this very example. Under the standard loan repayment plan, you would be paying $500 a month. But under this plan, by the end of the program, when you're making more money, you'd be paying $592 a month. The time it would take you to pay off this loan is that full 20 years. And the total amount of payments you would have made over those 20 years for a $45,000 loan is $83,822. And that's because of interest. Even though the payment plan is getting stretched out, you are still responsible for paying interest that accrues over that longer time period, which is definitely a big downside with all of the IDR loans. Now, by the end of that 20 years, you actually would have a balance. So the amount forgiven would be $3,856 if you were in a 25% tax bracket at that time. And tax brackets are extremely variable, so don't take that 25% as golden. You could be in a much higher tax bracket or you could be in a much lower one. This is just an example, so we're using 25%. So at that 25% rate, you would need to pay out of pocket that year $964, which means that the total amount that you would pay to pay off this loan is $84,786. So that is under the REPAYE program. And the REPAYE program, like I said, is really great. But I'd really encourage you to watch that video about IDRs to kind of pick what's right for you, because they'll vary in terms of how long you'll be paying them off, whether or not you'll have an amount that is forgiven, and how much that amount will be if it's forgiven, and the percentage of discretionary income that your loan is based off of. And you have to kind of look at all those factors and decide what the best route is for you. So after going through all of those calculations, I actually have some good news for you. And that's that the federal government makes comparing these IDR loans very simple. All you have to do is go to their loan calculator, which I will put a link for in the description below. It'll allow you to input your own information so that you can get specific results around what your monthly payment would look like, how long you'd be paying off your loan, how much in interest you'd pay. All of those things can be compared using the loan calculator. So I'd highly encourage you to check out that loan calculator if you kind of want to explore what all of your options might be. Now, there is something else that you need to be aware of with all IDR loans, and the REPAYE plan is no exception to that. The REPAYE plan is only valid for a single year. And so your loan servicer will reach out to you on an annual basis to check and see if all of your information is the same and adjust your payments accordingly. Now, if you have a change in circumstances that might lower your payments, you can have that number adjusted at any time. So if your family grows or your income goes down, that's something you'll want to reach out to your loan servicer about right away, because they can actually lower your monthly payments right away. You're not locked into that same payment amount for the whole year. But it's really important that you recertify that loan every year, because there are some penalties involved if you don't. So let's look at what these penalties are. I'm going to put them up on the screen so that you can see very specifically what you'd be looking at. So if you don't recertify, you'd be removed from the REPAYE plan. And instead of having that lower monthly payment, you would have an alternative repayment plan. And the required monthly payment on the alternative repayment plan would not be calculated based on your income. Instead, it would be calculated based on the amount necessary to repay your loan in full by the earlier of two things. First of all, the earlier of 10 years from the date you began repaying under the alternative repayment plan, or second, the ending date of your 20 to 25 year REPAYE plan repayment period. So that means whichever one is shorter, that's how they're going to calculate what your payment could be. So if you start this plan and after just a couple of years you fail to recertify, well, that means that you would have 15, 18 years left on your repayment plan. But the time that your alternative repayment plan started, it would be based on that. It would be based on that 10 years from the date that your alternative repayment plan started. So it's automatically automatically going to increase your payment because of that. What your payment would be over the course of 18 years is very different than what your payment would be over the course of 10 years, right? So you really want to make sure that you recertify that. Another thing to know is that if you fail to recertify, the loan servicer is also going to assume that your family size is 1. Even if it was bigger before, they're automatically going to just default to your family size being 1. So if you have additional dependents, well, your payment's going to go up. And last but certainly not least, that 50% interest subsidy that you were used to having, well, that will go away completely. And not only that, but your loan interest will capitalize. So what does that mean? It's not a good thing. You probably get the fact that it's not a good thing, but what does it actually mean? Well, you can kind of imagine your student loan being in 2 different buckets. The first bucket is the amount that you took out on your student loan, and the second bucket is the amount of interest that is accrued on your student loan. You're responsible for paying both. But the interest amount that gets calculated, so let's say it's 5% interest rate, right? The interest amount that gets calculated only gets calculated on that first bucket. It doesn't get calculated on the amount of interest that's already accrued. So remember how I was telling you that the government pays 50% of whatever leftover interest it is that you would have accrued that month? Well, there's also an additional benefit with all of these IDR loans that you don't have to pay interest on your interest. When a loan capitalizes, it takes that first bucket and it merges it with the second bucket. So instead of just having the $45,000 here and whatever interest you've accrued over here, that number, which would always have been calculated on whatever the balance was left in that $45,000 bucket, well, now you're going to add the interest to it, which not only means that you owe more money, but you're going to continue to owe even more money, exponentially more money as time goes on. So that is why it's incredibly, incredibly important that you recertify that loan every single year. It's a little bit of a pain, but the penalties far outweigh the amount of pain that you might experience just to recertify every single year. So now that you know about the REPAYE program, you might be asking yourself, well, how do I get one of these? It's actually really simple. All you have to do is reach out to your current loan servicer and they will get you started with this program. They are totally aware of what these programs are, what these IDR income-driven repayment plans are, and they will get you set up on one as long as you qualify. It really is that simple. You're probably going to have to provide some documentation to prove your eligibility, but beyond that, they are more than willing to get you into a payment plan that you can manage, because they would much rather be getting some money, less money from you, and have the potential to have that loan paid off over a longer period of time, rather than get you into a position where your student loans are unmanageable and you stop paying altogether. So it's a win-win situation. So hopefully this video has given you all the information you need to consider whether or not the REPAYE program is right for you. I'm definitely rooting for you to be able to hit that financial goal of eventually paying off your student loans or getting to a point where your student loans are more manageable and they don't take up so much of your budget. And if you like talking about personal finance, well, guess what? I do too. That's kind of what this channel is all about. I talk about personal finance all the time. I talk about investing, retirement, debt payoff. I talk about early retirement and financial goal setting. So if that is, in your realm of interest, and all you have to do to get that is hit the subscribe button. And it really also helps me out if you hit that like button. So please do that as well. So that is everything I have for you on the REPAYE loan. Like I said, hopefully it helps, and I will be going through all of those IDR loans at some point in the future, so stay tuned to that. In the meantime, I hope you have a wonderful week. Bye-bye for now.